Thank you very much for coming in, Mr. and Mrs. Hess. I'm very glad you're here. How was the traffic? Um, good. Did you find the location easily? Oh, excellent. Thank you. How are your children, grandchildren? Good. I'm so glad. Do you need anything? Coffee, water, something? Okay, great. Remind me after the meeting to validate your parking ticket, so this way would be okay. Okay, thank you. Today we will go over your financial plan. You provided many documents and information regarding your finances and the issues which affect your life. We will go over many items. I'm confident you will be pleased with our results. We spent some time on it and I went over many aspects of it to make sure that I touch on every item that you mentioned. Before we start, I'd like to tell you that all the documents and information you provided and we'll talk about today will be confidential. It's only for you and for your betterment of your financial plan. Okay, it's not going to go anywhere else. I know you completed several forms, including risk tolerance and other federal and state required forms. They are required by law, and there's no way around it. You have to read them and sign them. Some of them we need your signatures, some of them is just sent to you for your information, but those are to protect you and the whole plan. Please do not hesitate to contact me if you do not understand it. I understand some of those forms are long and they use legal language, which not many people might be comfortable with that. So please let me know. That's what I'm here for. Most of my clients feel more secure having your guidelines and financial planning in place in order to face future obstacles. This is just normal. If you had only a small item, just a few investment and so on, it would have been a lot easier. But since you have a vast amount of different investments, you do need to put them in place and make sure that you have a guidelines for the future, because each one of those investments would affect you on some other ways, and we want to make sure that we make sense out of those things. The financial plan is a very hybrid plan. It changes over time. It changes every time there's a change in your life. The factors in your life. I mean, you might get a new grandchildren, and that may affect it some ways. Some factors are controlled by you, such as investments or income or travel or buying a property or risk tolerance. And some others, they're out of your control, just like taxes and inflation and interest rates. It would affect you. So we want to make sure we're prepared for the unexpected, and that's what we're going to be doing. There are 2 copies of financial plans that I provided for you, and there are also 2 copies of your executive summary. Executive summary is kind of like a bird's eye view of your plan, and financial plan is the detailed one that goes through the whole numbers and everything for your information, and you would need both of them. Besides this, I would have a copy of my disclosure right next to you, and I'm going to explain to you exactly what that is. And also there's a form that needs your signature after we discuss your financial plan and you approved of this plan and would like to go ahead and start the process. First of all, has anything changed in the last few days that we talked about? If there's anything that changed, please let me know, because it might affect it. Well, if everything is okay, then we're going to go ahead and start. If anything changes in the future, please let me know, because everything might have a point that may affect other factors in your life and in your finances. We'll go over many specific recommendations and numbers to help you reach your financial goals. I know it might be overwhelming to most people, but I will explain it today and in the future again and again. One of the things that I really love to do is educating you to make sure you understand exactly where the money is coming and where is it going and how is it investing and how is it affecting your future. Things that many people may not know about it, how the taxes and estate planning affect your future. And I want to make sure that you understand that, and that's part of what I love to do. Okay. At any time, you could email me, text me, call me, or ask me any questions you may have. That's what I'm here for. Okay. The executive summary is a comprehensive look at your plan, and of course, we'll have some action plans so you would know exactly what you're going to be doing. Now, while I'm talking to you, I'd be looking at the monitor and the numbers, because I want to make sure that I don't make a mistake on that, and then we can go from there. Okay. As you recalled, you had several priorities, and of course, we made a few financial assumptions since we may not know the exact numbers of some of the numbers in the future, such as Social Security benefits or taxes and so on. So we'll make the best educated and calculated guess to go ahead from there. And of course, in the future, we will adjust those. So let's say if next year Social Security changes and they decide that they're going to increase the rate by 4% instead of 3%, we'll make the changes in there. If the interest rate changes or taxes changes, we'll always want to make sure we go up to date with that. We want to make sure that we meet at least once a year to make sure we're up to date with that. I don't want to fall behind or become too far away from you. And of course, that's the minimum amount. I would like to meet you again and again if things change. If something substantial changes in your life or in the economy, we would like to see you and to make sure that we make the rebalancing of your portfolio. Based on our conversation, we have touched on 5 key areas of financial planning, which are risk management, investment planning, retirement planning, tax planning, and estate planning. The financial plan and executive summary that I brought for you, it touches on all of them, and then we can go from there. Okay. Now, if you're ready, go ahead, open the financial plan, the executive summary, and then we're going to go over it. Okay. First of all, do you have any questions? Anything that might come to your mind? Please go ahead and ask anytime you come out to a question. That's what I'm here for, and I want to make sure I answer all your questions. First of all, I have a little bit of information about you. Those are the information that I gathered. So I go over it, and then now we can go from there. Okay. John, age 71, recently sold his manufacturing business. Mary, age 68, is a retired school teacher. The couple have 2 children, Edward, age 42, and Brent, age 40. 3 grandchildren, all in excellent health. Thank God. The scope of engagement: provide a comprehensive financial plan covering all major areas of Hess family's financial situation. Disclosure: this is the part that I wanted to make sure we understand. The insurance agent who introduced us has recommended that all insurance products recommended to be purchased through him. Now, you make the final decisions, but that's the disclosure, and I want to make sure you understand that. I will receive a payment of $1,333 from him if you become my client. Okay, and of course, there's a form there that I signed, and it is within your financial plan that explains that. I want to make sure you understand every one of them. Our understanding is that I'm not selling a financial plan for just a one time. I want to make sure that I'll be your partner for life. I want to make sure that I'll be there for every step of the way throughout your life. That's what I would do. Purpose of this plan is the goal behind providing you with the financial blueprint, and blueprint is to enable you to better understand your current financial situation. After realizing your current financial positions, we will be able to provide recommendations that will allow you to achieve your financial objectives. Our recommendation topics will consist of the following, which I mentioned, include the risk management, which is basically insurance side of it, investment planning, retirement planning, tax planning, and estate planning. Ultimately, we will provide you with an identifiable actions you can take to ensure your financial goals and objectives are achieved. Your goals. Your financial goals are to be able to develop a comprehensive financial plan and one, reduce any state and gift tax liability that ensure all state planning documents are in order. Well, first of all, to lower your taxes and then make sure all the documentations are in order. Number two is review insurance contracts and discuss the implications of purchasing a long-term policy. Number three, reduce personal income taxes. And number four is based on your current risk tolerance level, recommend a diversified portfolio that meets the Hess investment needs and expectations. Your risk tolerance, you completed the risk tolerance questionnaires and were in agreement with the results. It was determined that they will be willing to assume an above average level of risk as it relates to your investments. Economic assumptions, these are the assumptions that were made. Your current marginal tax rate is approximately 44%, and we'll make the assumption they would remain the same in the future. And of course, we will change that as time passes and the tax rate changes, and of course, your investments and so on. The inflation rate is set at 2.25%. The risk-free rate assumed to be 1%, while the market rate premium expected to be 7%. Now, as I said, every one of these numbers may change in the future, and we're prepared to change them as time comes. Your financial health. Your current net worth stands at $14,148,590. This amount consists of mostly investable assets, standing at about $10,689,222, and has a very small amount of total liabilities at only $65,632. Your net disposable income for the year stands at $1,296,087. However, this is significantly larger than future years, as John received a $1 million down payment for the sale of his business. He received it this year. So we want to make sure you understand that you're not going to be receiving that amount in the future. Instead, you're going to be receiving installment payments, which is substantially lower than this amount. Subtracting this would leave your net income at just under $300,000. Your sizable net worth coupled with your large discretionary income will allow you to achieve your financial goals. That's number one. Number two is we calculated various financial ratios to determine your financial standing compared to your benchmark. You perform exceedingly well. Your current ratio, which measures your ability to meet your short-term liabilities, and with your short-term assets, what at over 3,600%, which is way above what we usually see. Your low level of debt means that you have very little credit risk. Your debt ratios are all exceptionally well and leave no concern for your ability to meet your financial obligations. These are all good news. Your emergency fund is of sizable amount. Currently, you have approximately $850,000 in cash and cash equivalent. We would like to see an amount that would cover at least about 3 to 6 months' expenses. Holding this higher level of assets will ensure that you're able to meet any short-term funding needs. Okay. This will protect you from having a long-term, less liquid investments to meet any short-term funding. So that means you do have enough funds to meet any issues that come around for short-term. Holding too high cash and cash equivalent can have a negative impact on your investment. That means you have cash amount that is sitting in your bank but not getting what they deserve. Funds that are not needed to cover your short-term expenses should be diverted to a long-term investable assets that will provide a higher rate of return. Given your substantial level of cash and cash equivalency, we would recommend some of these funds to be diverted to a longer-term investable assets, which will help you achieve a higher rate of return. Do you have any questions? Is everything okay? Did they make sense to you? Do you agree with that? I'm glad. We go to the risk management. A detailed scenario analysis and in-depth review was completed concerning your health, auto, homeowner, life insurance, annuities. Below is a summary of some of them. Your homeowner coverage. Adequate homeowner coverage needs at least 80% of fair market value of your home. Your current vacation home coverage is about $460,000, which is less than 80% of what the home is worth. And we're talking about just the dwelling value of it. We're not talking about the value of the property. So in that case, you should be your primary residence is currently underinsured by about $220,000. Your coverage is at $400,000 versus it should be $620,000. That represents a shortfall of about $36,000 for every $100,000 in losses. Additionally, since the vacation home is near a river prone to flooding, we would like to recommend that you would get a flood insurance for that. Auto insurance. Your auto insurance covers your needs at about $200,000 per person for injury, $600,000 for total limits, and finally a $15,000 limit for damages. Those limits are far too low to protect you and your assets if you become involved in a serious accident. We recommend increasing your limits to meet a minimum requirement to qualify for a personal umbrella policy. We have the recommendations on number 5, which includes the umbrella policy. But just to touch up on that, currently umbrella policy requires minimum of $250,000 per person, $500,000 per accident, and $100,000 property damage. Just to give you a note on the property portion of your auto insurance, which you have only $15,000 coverage, that's extremely low, and we suggest you change that immediately. Health insurance. Your current health insurance coverage adequately covers your needs, and it would be our recommendations to add a long-term care policy to it. Your current long-term care deductible limits for John is $5,640, and for Mary is $4,520. The policy you are quoted would fall within those limits and will provide the policy benefits for 3 years. And this would be shortly longer than the average duration of a long-term stay. Life insurance and annuities, that's number 4. Given that your children are grown and that you do not anticipate future state tax issues, additional life insurance is really not needed at this time. So we can the current basis on the annuity stands at about $25,000, and the current fair market value is $102,000. If you were to convert this to an income stream, assuming present value of $102,000, your return on basis would be about 24.5%, meaning that a little over 75% of your payment would be taxed as ordinary income. Given you are already substantially income stream and high tax rate, we would not recommend converting this annuity to an income stream. Gifting the annuity may be a strategy to remove the asset's growth from your estate and shift the taxation to a lower rate. That's what we recommend. Now, there are other issues that we may touch up on that. One of them is to have the annuity with a long-term care rider added to it. That one we can do in order to maximize your long-term care needs. Personal liability policy, this is called umbrella policy. We would recommend adding a personal liability to your provide liability coverage above and beyond what your homeowner and auto insurance coverage provides. Based on our 20-year plus of experience in insurance, we recommend that umbrella policy equal to your entire assets. In your case, we think a $10 million umbrella will cover you 99.99% of the time. Certain assets are protected and would not need insurance on that. So in that case, what we figured it was that Well, with the $10 million coverage, your rate would be at $1,650 a year to cover both of you. Investment planning. Okay. Before we get to investment planning, do you have any questions regarding insurance? You could ask me anytime for any reason, any question you might have. I know I'm giving you a lot of numbers and a lot of suggestions, so I know it's easy to get lost in there, but please make sure that you understand I'm here to help you, and then you can ask me any question you may have. Investment planning. An investment policy statement and an analysis of the investment portfolio were prepared for your review and are attached to this plan. Current investment position, you currently have about $3,847,682. I say about because I don't want to go into cents, so I just go with the dollars. In a non-qualified asset, and you have $1,159,540 in qualified assets. Additionally, John holds a stamp collections, which is collectible, and it's worth about $750,000. Recommendations. The current stock portfolio consists of only 5 stocks. Ideally, a diversified stock portfolio would hold about 20 to 30 different positions. Additionally, their return is underperforming the market, and the cost basis is greater than the fair market value of portfolio, allowing the tax harvesting opportunities. So that would be a wonderful idea to come up and try to cut off the taxes from it. We would recommend adjustment to this stock portfolio to further diversify your holdings. No changes would be recommended for the mutual funds. These assets are in line with your overall risk tolerance, and they have high coefficient of determination, meaning that the portfolio managers are doing a good job. We checked on them, and the portfolio is just fine. That's the way we want it. John's retirement portfolio is invested 100% in equities. We may want to consider diversifying the asset types within these portfolio to provide and to help reduce their risk exposure. Additionally, John will need to start taking required minimum distributions next year from his 401k plan. We see no changes needed to Mary's 401k as he invested in a diversified target date fund in line with her time horizon. Future investments recommendations should follow the attached asset allocation summary based off on above average risk tolerance. Aligning your future investments allocations with this risk tolerance will best allow you to achieve your required rate of return. Additionally, the purchase of municipal bonds can also be used to provide tax-free income for your bond portfolio, and we highly recommend that. Future investments would also avoid the purchase of tobacco-related companies, and we understand that, and we had checkmarked them to make sure that we follow your required recommendations. Diversifying your current portfolio away from these investments immediately will incur significant tax consequences, as the holding will be within your mutual funds and would incur capital gain taxes on the gains. Retirement planning. Before we go to retirement planning, do you have any questions? Have I answered all your questions regarding these items so far? Good. If you have any questions, you could just interrupt me, or you could just write it and let me know. Or if you thought about it after the meeting, you could just text me or email me. Everything is secure and it's just between us. Retirement planning. After conducting a comprehensive retirement needs analysis, we determined that your current financial position is meeting your retirement needs. Your inflation-adjusted rate of return was calculated at 5.62%. This high rate of return will ensure that you preserve your current accumulation while growing at a rate of 5.62%, subtracting the inflation rate. Concerning IRA contributions, the maximum contribution amount for John for 2021 is $6,000 to a traditional IRA. He is not an active participant in another plan and had earned income for 2021. The combined income reported for 2021 will exceed the threshold for the Roth IRA contribution for both John and Mary. Mary would be unable to make a deductible contributions to a traditional IRA for 2021. Income is too high for the spousal IRA contribution. Despite this, we would recommend Mary make a non-deductible contribution to an IRA. File form is 8606. She can then convert these funds into a Roth IRA to avoid future taxation on the gain. John will need to begin taking required minimum distributions next year 2022. Our recommendations to avoid taxations on the required minimum distribution would be to withdraw these funds and send them directly to a qualified charity via the qualified charity charitable deductions. This may just help you a lot, since your money is gonna buy you a lot more than what you're paying for, and we highly recommend that. To qualify for this special tax treatment on the required minimum distributions, the funds taken needs to have originated from an IRA. To accomplish this, John would need to roll over the funds from his account, 401k account, into an IRA. The fees for the IRA may be slightly higher. However, the tax savings will compensate for this increase. Additionally, the equivalence of investment options will be available under both. Tax planning. There's no way not to pay taxes, but you have to make sure that you adjust your taxes so you pay the fair amount of taxes at all times, and not to have mistakes done to take away more than what you deserve. After a detailed income tax analysis, the tax treatment of sale of John's manufacturing business will consist of long-term capital gain of $731,250 for the $1 million down payment. The subsequent installment payments will realize a long-term capital gain of about $16,740 per monthly installments. Per monthly installments is $36,568. Your taxes would be $16,740, or total of about $200,880 for the year. John's stamp is currently valued at $750,000, and he has a cost basis in the stamp of $500,000. Since collectibles are taxed at 28% flat rate, he would incur his $70,000 tax liability if he sold it today. Additionally, he sold it in 10 years for $1.55 million with a 15% tax sales commission. He would incur a tax liability of $228,900. Given the family's high marginal tax rate of $44,000, the family may want to add additional tax-favored investments such as municipal bonds. Additionally, they can purchase ETFs or shares in the growth-oriented companies that would be reinvested the majority of their current earnings back to the companies. Estate planning. Detailed estate planning calculations were completed and are attached to this form. Current situation is neither spouses have an estate tax due. You do not owe any estate taxes at this time. Your total assets amounts falls within the current estate tax assumptions, which is $11.7 million per spouse. Therefore, your assets will not be subject to estate taxes. Administration expenses are expected to cost about $250,000 per spouse. Wills are in place, naming each spouse as primary beneficiary and the children as 50-50 contingent beneficiary per stripes. No healthcare proxies or power of attorneys are in place. Our recommendations is change the title of the vacation home from sole ownership, which is under John's name, to joint ownership with rights of survivorships to ensure no probate costs are associated with this property. Additionally, ensure transfer on death agreements are in place on John's CD and mutual funds accounts. Alternative, a joint mutual funds account could be opened and the assets transferred to that. Either method would ensure probate is avoided. This is what we recommend highly that you do it immediately, is speak with a licensed estate planning attorney to draft a power of attorney, one for each spouse, John and Mary, and to establish healthcare proxies to determine your healthcare directives. The cost of estate planning services generally is about $10,000 to $15,000, depending on the complexity of the situation. Our action plans, or this is what we came up after all the calculations, is that after a comprehensive review of your situation, we concluded the following recommendations. We would recommend you divert a large portion of your cash and cash equivalents to longer term investment assets that will provide you with a higher rate of return. Your current level is exceedingly high and is reducing the overall return on your portfolio. Number 2, increase the face value of your HO3 policy on your primary residence from $600,000 to $620,000 coverage for the dwelling to ensure your property is covered properly. Additionally, we recommend the addition of a long-term care policy, which you could add it to your healthcare or you could add it to your annuity. The purchase of a large personal liability policy umbrella should also be considered. Diversifying your investment stocks portfolio to better align with your investment risk tolerance. This will ensure proper diversification and a better aligned risk-adjusted rate of return. Additionally, some tax losses should be able to be harvested and can be offset towards the year's substantial income. Number 4, IRA contributions should be made for both John and Mary. Deductible for John and non-deductibles for Mary. A conversion into a Roth can be completed subsequently for Mary to ensure tax-free growth. We also recommend John transfer his 401k plan to an IRA to allow for qualified charitable distributions for his required minimum distribution to start in year 2022. Number 5, meet with an estate planning attorney to ensure that all estate planning documents are in place. Healthcare proxies and power of attorneys should be established for both John and Mary. We do have other additional recommendations which I would like to discuss with you. Begin considering charitable gifting techniques to reduce your sizable net worth and to reduce your net income. 529 college saving account contributions can be made to each grandchildren. The maximum at this time is $15,000 per person, per grandfather or grandmother. So we're talking about $30,000 per grandchild for up to 5 years in advance. So total would be approximately $450,000, which can be taken out of your estate and directly given to the grandchildren. They can use it tax-free as long as it's used for educational purposes. Divert a portion of cash and cash equivalents into investable assets. Given your low level of liabilities, excessive cash reserves are not needed and will reduce your overall investment returns. Investing these in longer term diversified assets as discussed under the investment sections will maximize performance while minimizing your risk. And at the end, I would like to tell you that the $1 million down payment which John received for the sale of his manufacturing business should be invested according to his investment section of the plan, along with all the subsequent installment payments. This concludes my executive summary for you, and I hope you would like that. And at the end, you can ask me any question you may have, or if you think you're comfortable to go ahead with that, please go ahead and sign the forms so you could go ahead and start your plan at this time. Thank you.